In candle range theory, each individual candlestick has its own range, defined by the difference between its high and low price within that specific time period. The phrase "every individual candle actually holds its own range" means that each candlestick represents a self-contained trading range, independent of other candles, even though it exists within the broader market structure. When analyzing a daily candlestick across different time frames, we can see that its upper and lower wicks correspond to the swing high and swing low in lower time frames. This suggests that each candlestick can be broken down into smaller, isolated price ranges on lower time frames, where price action unfolds in a structured manner. This concept highlights that price movements can be analyzed within the context of individual candles, revealing micro-level market structure, liquidity zones, and potential trade setups. However, while each candle holds valuable information, its range is most effectively interpreted in conjunction with broader market trends, key support and resistance levels, and order flow dynamics. By understanding how price moves within each candle's range, traders can refine their entry and exit strategies, identify liquidity zones, and enhance their market timing with greater precision. Market movements and candlestick formations are largely driven by one core principle: filling liquidity gaps. If you examine any random price chart, you'll notice a common pattern. Each candlestick often probes high or low of the previous one. This behavior isn't limited to individual candles. It's a fundamental characteristic of the overall market structure. The market consistently seeks out previous highs and lows, frequently revisiting areas of imbalance where liquidity gaps remain unfilled. But what is the complete definition of internal and external range liquidity, and how is it related to candle range theory in the market? Internal range liquidity refers to liquidity that builds up within a trading range, typically between the highs and lows of a consolidation zone. A consolidation zone refers to a period in which an asset's price moves within a narrow range without exhibiting a clear upward or downward trend. On a chart, this typically appears as sideways movement. Typically, sideways market movements aim to fill liquidity gaps, often by bringing the price back to fair value gaps. External range liquidity refers to liquidity that lies outside a major range, often beyond the most recent swing highs or lows. It represents breakout zones where larger pools of liquidity exist. Swing highs and lows are considered resistance and support zones, which is why a lot of liquidity tends to accumulate around them. The market often sweeps this liquidity by breaking through these levels. Internal range liquidity aims for the price to reach the fair value gap, while external range liquidity seeks to break through the previous high or low. This is part of the market structure. Price often targets previous highs and lows to capture liquidity. When a new high or low is formed, price typically returns to zones of previous supply or demand imbalances to mitigate unfilled orders. This retracement allows the market to rebalance before continuing in the direction of the prevailing trend, often forming a higher high or lower low as a result. But how are ERL and CRL integrated into the CRT model to allow us to enter trading positions with greater confidence? Candle range theory is a price-action-based trading approach that focuses on the range between a candlestick's high and low. The core pattern involves 3 candlesticks. The first candlestick establishes the initial range, high to low. The second candlestick manipulates this range, often creating a false breakout or trapping traders. The third candlestick acts as a distribution or confirmation candle, typically signaling a reversal or significant market move. Now, when the market reaches either an internal or external range liquidity zone and a CRT model forms, we can be confident in a potential market reversal. At that point, we can enter a trade after receiving confirmation signals in that area. In other words, if the price reaches an external range liquidity and then forms a CRT model, the internal range liquidity becomes our target. Conversely, if the price reaches an internal range liquidity and a CRT model forms, the area above the previous high or below the previous low will serve as our trade target. Let's explore this concept with a live example on the chart. In an upward trend, the price broke through key resistance zones and formed new highs. At the first significant high following a break of structure and a sweep of external range liquidity, the CRT pattern emerged. This suggests that the price is likely to retrace toward internal range liquidity, specifically targeting the fair value gap, FEG. As price reaches the fair value gap, a range candle forms, followed by a candle with a downward wick that manipulates the range area. This wick indicates a liquidity grab, which strengthens the expectation of another move toward external range liquidity. If price then forms another CRT pattern above the newly established high, a trade entry could be considered, anticipating a return to the internal range liquidity, FEG. However, if no CRT pattern forms near the internal or external range liquidity zones, those areas should not be considered valid trade entry points. So, what time frame should we enter a trade on, and what confirmations do we need? In this strategy, we first analyze the chart on the daily time frame, then enter a trade based on signals from the 1-hour time frame. On the daily time frame, we first identify the range and the manipulation candle of the CRT model when the price reaches either external or internal range liquidity. We begin with the first model by identifying the range candle. After that, we switch to the 1-hour time frame. As mentioned at the beginning of the video, each candlestick represents a trading range. On the 1-hour time frame, the range and manipulation zones are clearly visible. You can see that the price has swept the liquidity above the range, followed by a market structure shift. Therefore, we can wait for the price to return to the order block or fair value gap area to look for a trade entry. As you can see, the price has broken through this area and triggered the stop loss. It's important to remember that no strategy is 100% profitable. On the daily time frame, we can also observe that the price has moved upward and formed another CRT pattern. Now, let's analyze this new pattern on the hourly time frame. Once again, we can see that the price has swept the liquidity zone. Following this, a market structure shift occurred. Therefore, we identify the order block or fair value gap as the entry zone and place the stop loss slightly above this area. Importantly, the take profit is set at the internal range liquidity zone. With the market's movement, we see that the price reaches the take profit. As we mentioned, if we enter a trade in the external range liquidity, we set our take profit on the internal range liquidity area, where the breaker block and the fair value gap overlap and vice versa. Now, let's examine the third model on the 1-hour time frame. Once again, we observe a liquidity sweep with an upward price spike, followed by a market structure shift. We then identify the most recent order block or fair value gap as our potential entry point. A stop loss is placed slightly above this zone, while the take profit is set at internal range liquidity, ideally where the fair value gap and breaker block intersect. It's not absolutely necessary to enter a trade at the external range liquidity. As mentioned earlier, the market is oscillating between two zones. We can wait to enter a trade when the price reaches the internal range liquidity and a CRT pattern forms. In this scenario, the external range liquidity can be used as the target. Once again, in the 1-hour time frame, the same rules apply. After the liquidity sweep and the break of structure, we identify the order block or fair value gap as the entry area. This time, we select the area near the external range liquidity as our take profit zone and wait for the price to reach that level. I hope this video was helpful to you. Please don't forget to like and subscribe.